Welcome to a special edition of the Hot Seat, our 2024 annual report. We have a special all-star cast of panelists with us right now that have just done tremendous work in the M&A world over the last year. So without further ado, let me bring them in right now. First, Billy Hart, tell us a little bit about yourself and some of the acquisition work that you've done in 2023.
Sure. Thank you, Spencer. So Bluejay Capital focused on T&L only. Our backgrounds are owners and operators, buyers and sellers of transportation companies. So it's all we know, so that's all we do. In 2023, which I think we all could agree that it was a tough market, we're pretty pleased with being able to deploy a little over $200 million in capital. One of which was a deal that was represented by Spencer and his great team there at Tenney. Was our platform with priority of couriers. We also did an add-on to one of our other portcos called BWT, warehousing transportation, and then two add-ons with our portco called PacWest. So it was a good year, a very tough year, but this year's shaping up pretty good. We've got 2 under LOI as we speak and 4 under IOI. So we've remained busy.
Good deal. Thanks for being here. Can't wait to hear more. Dan Carpenter of Trimac, tell us a little bit about yourself.
Thanks, Spencer, and thanks for having me. It's a pleasure to join your group and the panel. I work with Trimac Transportation and lead our M&A activity for the company. 23 was a great year for us. As Billy said, it was a tough market, but we were able to pull off 4 transactions worth a little just under $90 million in total acquisition dollars purchased. We did a little bit of everything. We tried to spread around the 4 acquisitions so that we weren't overloading any one part of our operations team, and each group sort of had a little bit. We did some in the Southeast U.S. We did some in Eastern Canada, some in Western Canada, and up in Ohio, which was a market we hadn't previously been in. So a great opportunity to put some new dots on the map, continue to grow and make the best of what was a challenging environment.
All right, Dan. Thanks for being here. Last panelist, Geoff Anderman, President and CEO of STG Logistics. Geoff, tell us about what you guys have been up to the last year.
Yeah, thanks, Spencer. So we did a couple acquisitions in 2023. We did 2 simultaneous acquisitions at the beginning of the year of folks playing in the LTL or less than truckload mode. And then we also bought a truck brokerage, over-the-road truck brokerage in May of 23, a company called Best Dedicated Solutions, actually based here in the suburbs of Chicago. And all of our acquisitions in 2023 have really been about adding services that we think complement our existing portfolio that we go to market with our customers. So a busy year from an acquisition perspective. I would say they were all kind of tuck-in acquisitions or add-ons, to use kind of the words that Billy used earlier. But really, really complementary, and we're excited to kind of have them as part of our portfolio here going forward.
All right. Well, now we've set the stage. We're going to heat things up a little bit, but just for our audience, what we're really trying to do as part of our annual report is just different perspectives, doing deals in different modes, using different sources of funds, different perspectives. And my hope is that through their collective experience and insights, we're going to provide something special to our network here. So with that, let's jump right in with a lightning round of questions. So you've already kind of alluded to some of this, gentlemen, but couple words, couple thoughts, phrases, 30 seconds or so. How would you characterize the 2023 M&A market? Let's go. Let's start with Billy.
Difficult, right? And volatile. So we came off of post-COVID bumps and fourth quarter 21 valuations, which were sky high. So trying to get deals done on the heels of all of that, when capital was more expensive, uncertainty in the economy and geopolitical, particularly if you were looking to do international deals. that made it tough. And then and Spencer, you've mentioned this before. The sellers are remembering that, the fourth quarter 21 and the sound bites coming from that. So having all of these things that are making it difficult to do a deal, and then on your counterparties are thinking valuations aren't really where they needed to be because of all those headwinds, was probably the biggest challenge, I think, for all of us in 2023. But still, if you're patient and you're flexible, you could get deals done. But I think if we made it through 2023 and had some wins, then I like our chances in 24.
Good word. Dan, what would you add to that?
I think that's a good summation. The gap in expectations, I think, is how I characterize what Billy said, between buyers and sellers. 2022 was a record year for a lot of people in the trucking space because of high fuel surcharges that outpaced the cost structures, and a lot of price because of the driver retention issues that we had in 21 and 22 coming out of COVID. So really good tailwind sort of from the earnings perspective. But as interest rates started to rise, multiple WACs were going up on the interest-free rate, and so WACs were going up, multiples were coming down. Also saw, a lot of the bigger funds that were PE maybe that plays with a lot more debt leverage moved to the sidelines. A lot of bigger deals that you were expecting to come to market didn't, waiting for a time when it was a little bit more ripe. And so, that difficulty in the market was absolutely real. But we found that if you're committed and to being creative and being cooperative and flexible, as Billy said, you can get deals done because there were fewer buyers there as well. And I think you still had a lot of sellers that knew that the look forward was rocky and murky with high interest rates and slowing economy. That the trailing 12 months were probably as good as they were going to be. And so the time was right. And so we were successful harvesting that for sure.
All right. Now, Geoff, to keep with the theme, you're going to have to say C words. We've heard challenge. We've heard cooperative. We've heard creative. So what would you add in terms of your summation of 2023 M&A?
Yeah, I mean, Billy and Dan said it really well. I guess maybe the thing I would, or the direction I would go is think about the themes that they highlighted and kind of map those onto the actual transactions we did in 2023. And what they described is kind of exactly what we kind of went through, right? Mm-hmm. Which is, we had a couple acquisitions where candidly, maybe they didn't get, kind of every last dollar that they could get because, they had a little bit of an expectation gap with us and them in terms of valuation, but it made sense for them to transact. They liked us as a buyer. And honestly, they had other dynamics that were maybe more important to them than getting every last dollar, getting, a full valuation on 2022 or whatever, because, they had partnership dynamics they were working through or succession planning or whatever. And that's what allowed those deals to kind of come together and happen in a market where, maybe they otherwise wouldn't if those considerations weren't at play. And again, if we weren't being creative and kind of solving for some of those partnership dynamics or succession planning things or whatever was at play in those particular deals.
Mm-hmm. So excellent way to start this. So let me transition to our first mini hot seat panelist, Geoff Anderman. So Geoff, I want to lean right in there to what you just said, because we experienced this in many deals. The folks that were on the sell side, which to be fair, this is very challenging in terms of the whiplash of what was available in the market just 12 to 18 months ago, and the expectations. And so I have a much respect for not just the sellers in our transactions, but for the others that were able to educate themselves about the realities in the market. But like you said, I think this is so true. You got the deals done because ultimately they wanted to do a deal with you. Mm-hmm. And I think that helps accelerate getting a meeting of the minds on the realities in the marketplace. But how do you do that? Like you guys have been successful with multiple deals, which we'll unpack here in a second. What is how do you think about creating that trust where someone at the end of the day wants to do a deal with you, even if it means not squeezing every last possible penny out of a deal?
Yeah, I think a lot of it comes down to establishing personal relationships with the folks that you're sitting across the table from, right? And so I do believe that that's something that we take pride in and kind of emphasize and prioritize and do well at STG. So if I think about those particular deals, they were kind of warm introductions that we got from folks in our network or through other kind of folks that we know, and thus had kind of a stamp of approval or some social proof around who we are and what STG is, and we took the time in each of those transactions to kind of understand what was motivating the sellers, whether it was really about simply money or valuation, or whether it was we're looking for someone to steward something that they created into the next phase of the life cycle of the business, or if there was some other kind of consideration that they were trying to address, and that's really what we did, and I think that's something that we're pretty good at. Obviously, the numbers always have to make sense. We're owned by private equity, and if numbers don't make sense, things don't happen. But that's kind of how we think about it and approach the world. We spend a lot of time trying to develop those relationships up front, and are really looking for people on the other side of the table who have a vested interest in continuing to be part of the business, whether it's focused on the specific business we bought from them, or part of a new kind of broader role as part of STG going forward.
Yeah. What do you see in terms of that roll forward equity, which I believe that you're describing right now? Like what, in general, last half a dozen deals, what do you see, or just through peers doing the same thing? What do you see in terms of the percentage of the total deals that have that type of component as part of it?
Yeah, I mean, we really focus on trying to get some component of the consideration, so to speak, as contingent, so to speak. So again, obviously everybody's familiar with earnouts. Earnouts are a tool that can be used to bridge valuation, expectations gaps, as you know very well, Spencer, right? Particularly in the environment that we've been in over the past year or two. But we do like to offer people the opportunity to kind of roll into the broader STG, where it makes sense for them, where it makes sense for us, where we think that we can give them an opportunity to generate additional upside for themselves, and kind of also align incentives around if you win, we all win kind of thing, and vice versa, right? So it's very common for us. It's a common approach or a tool in our toolkit, and certainly something that if we sit across from a seller and they ask for it, without us even bringing it up, that to us is a good indicator that they're really interested in being aligned with us around kind of short, medium, and long-term goals.
Well said. Let me ask you this. This is a headline from a press announcement of your deal in 2022 of XPO on their intermodal division. It says STG has expanded its leading position in containerized logistics. And so my question is this: what compels an organization like yours to continue to grow via acquisition when you're already an established market leader?
Yeah, so we when we did the acquisition of the intermodal business from XPO in 2022, we had a very successful platform at STG Logistics in terms of offering an intermodal solution to certain logistics intermediaries, primarily non-vessel operating common carriers, where we would consolidate and deconsolidate less than container load LCL freight that was coming into the United States, and then move it inland for them via a kind of a third-party purchase transportation intermodal solution. And we looked at that intermodal business for that XPO was marketing at the time, and said, this is an opportunity for us to vertically integrate our solution there, insource the service that we're currently outsourcing to third parties, and control kind of the full kind of port to door movement of goods. And so we just saw it as a great strategic fit, great operational kind of synergy, efficiency synergies and opportunities there. And then also it allowed us to kind of tap into some customer segments that we weren't really scratching the surface on, candidly, in our legacy kind of STG business at the time, which was highly focused on selling to transportation intermediaries, and less so focused or on selling directly to shippers. Coming out of XPO, I think everybody's familiar with XPO, kind of, and what they have done and accomplished and built over the course of 10 to 15 years. But great relationships with large enterprise shippers, and we saw an opportunity there for us to cross sell into those folks and sell some of the STG services that we had been doing before the acquisition of Intermodal to Intermodal's customer base.
Well, thank you for that. That's very helpful. So sticking with the headline theme,
Yep.
just November 17th, you teased this deal out with the best dedicated solutions, but similarly, there's a comment in the announcement that talks about customer-centric culture within the just customer-centric, and that being in some way influenced the strategic rationale for the deal. So my question is this: how does your organization approach culture compatibility when you're looking at deals? Like, how do you even do that?
Yeah, I mean, I think I spent a lot of time with the best dedicated leadership team, and then kind of the next level down as we were evaluating that opportunity, and that was over the course of multiple kind of in-person meetings in their office, as well as, I would say, dinners and kind of hanging out outside of the office, and just getting a feel for kind of the vibe around their office, right? And as it relates to BDS in particular, I mean, we spent a lot of time with them. I had very encouraging discussions with them around culture that they brought up, not necessarily that was coming from us to them. So it was very clear to us that taking care of their employees, taking care of their customers, and having a positive culture, a great atmosphere around the office was something that was very, very near and dear to their hearts. And candidly, that just resonated with us as we looked at that particular opportunity.
I'm curious, the more that I talk to, the best of the best acquirers, some of the feedback that I get is just like, you're not going to home grow winning the future. And so I'm curious, how do you think about that as it relates to talent, both talent development and then also just talent acquisition through the course of transaction work?
Yeah, I would say the most successful and kind of best acquisitions we've had, we have always had kind of multiple levels of talent that have come with that business. In terms of, when I say multiple levels, I mean leaders, but then the next level down, maybe the next level down below that, there's talent kind of throughout the organization. And when you're buying, I'll call them smaller companies, using that term loosely. When you're buying smaller companies, talent, it's an arms race for talent, right? And you can't meet some of these smaller companies and expect them to have A-player rock stars everywhere. Like, it's not kind of the reality of the talent marketplace that those folks play in, and we all play in, candidly. But when we found, when we have a strong leadership group and a strong next kind of level leadership group in a company that we acquire, that's usually a very, very good indicator that it's going to be a successful acquisition, that you have people there who understand what it is that they're trying to do, understand what it is we're trying to do, can adapt and handle change, because ultimately there's always change when there's a change of ownership. And that's kind of how we think about that when we look at and evaluate these companies. It's not just about what the numbers say. It's not just about, hey, you can do this, we'd really like to be able to do that too. It's really about like, people is such a huge component of it.
That's a good word. Geoff, thank you for the excellent comments. I think you can handle the heat. I think you did a great job doing that. But let me stick with you. We're going to start a new lightning round here. I'm curious to know, what is a deal in the transportation logistics space 2023 that you thought was particularly transformative or interesting that you weren't a part of?
Sure. Yeah. I mean, I think the one, it's a little bit of maybe an easy answer, but I think the one that obviously has gotten a lot of attention from folks over the course of the past, call it 3-6 months, is obviously the Forward Air Omni transaction, right? And obviously there's a lot of noise around that one right now. It is fun to watch. I like to pop a batch of popcorn and flip my phone open in the evenings and scroll through Twitter or FreightWaves or whatever to see what the latest and greatest is on that one. But that's obviously one that has been very, very interesting and very top of mind in terms of news feeds and stuff over the past 3 to 6 months.
Good deal. What about you, Dan?
Well, to be honest, our blinders are on a bit around the bulk segment, so we don't have a ton of perspective on things, modes outside that. But in our space, it's probably more about the deals that didn't happen. There was a lot of platforms, Quantix, quality carriers, CAG, who've been Superior, Hennef, who've been rumored to be ripe for a private equity to sort of let them go or resell them into the market. And they didn't happen. So not a lot. TFI continued to be quite active with their, I think it's the Seiki or acquisition and several others that they did. So they're very active and sort of a role model of ours, but not a lot going on in the bulk space really, which was a surprise and for us a benefit because there wasn't as many buyers and an opportunity to pick up some really good companies along the same lines as what Geoff talked about. Relationship oriented, value, talent, all those kinds of things that make them really successful.
I like it. Billy, what say you?
I would say, so Dan flashed the Dasky acquisition by TFI. That's an interesting one. I mean, TFI is very, very active and buys many and varied assets. I think Dasky is going to be a challenge for them and anybody else. I mean, it's, that company had never been really integrated. So you've got a couple of entrepreneurs that are sort of running their own show. I know they've done some integration prior to that acquisition. That'll be a really interesting one to watch to see how,
especially with my apologies, especially with flat deck hauler munitions portfolio. And they have a lot of bulk transportation. They've got the UPS platform. It's just a very different thing. It's a bit of a trying to conquer everything.
Yep.
So it'll be interesting to watch how they can do it. But they have proven, I think, 100 plus deals in the last 20 years. They've proven if anyone can do it, they can.
That's right.
They've had a lot of practice.
That's right. Well, Billy, let me stay with you, and we'll heat things up here a little bit. So, M&A, team sport. You agree with that?
Absolutely.
Yeah. So why is it so critical to have industry experts around the table at every key function, be it legal, be it, you're doing diligence, be it on the advisory side? Like why is that so important? And why do you, obviously I know that you guys get behind that, but like, why is that such a key part of being successful at the deal table?
Well, I would say, Spencer, and I think everybody on this call understands that it's really easy to not do a deal, right? And even if best intentions, a deal is going to go into, like I like to say, go into the ditch at least 10 times. And so the more folks you have around the table that are smarter or have additional viewpoints, context around it, I think is absolutely key to getting a deal done. Because the economics are sometimes tough and absolutely important, but there's so many other aspects to it. I mean, Spencer, yours and our deal, really did require us to all kind of join forces to get it done. Not that, no bad intentions there, but we had to get all the right legal folks in there, the tax folks in there, risk mitigation folks in there, just to get, to really get it done. So, So from that standpoint, the stronger the team that you have around you, around both sides, and there being very, very open, honest conversations, sometime, to not to the detriment, but sometimes without worrying so much about the negotiation portion of it, but more about how are we going to get to a collective goal of getting this closed, becomes more important than getting that additional value or winning on that one particular argument. And I think having smart folks with experience and depth of understanding is required to be able to be successful.
Yeah, I think that's what a lot of folks, both buyers and sellers, probably don't fully appreciate if they haven't done multiple transactions. That at some point, particularly in larger transactions, you get to a point where everyone effectively does get on the same side because everyone does share the goal of getting to the finish line.
Yeah.
And so all experience, all creativity is on the table to try to figure out how to solve for that. And I appreciate that approach. Kind of another question that I hope is helpful to sellers. You mentioned 4 transactions. You've got multiple under contract, even with the challenging environment. I know how many deals that you guys look at that don't make it that far. And so my question is this: when is it easiest to give a fast, hard no to a company that on paper is a good company?
The management team. For us, that's number one. And so the faster that we can have a conversation with the folks that are going to be staying post close, because we bet on the management team. We're not as strategic, like STG and Trimac. Yes, we deeply understand the industry, but we are really betting on the management team. And so if we have that conversation and it doesn't go well, they could be great folks, but if they don't, if they don't share a vision of not only rolling equity, but also staying on for the next level of growth, that's a non-starter for us. So that's for us, that's the big first hurdle.
Mm-hmm. So do you feel like, to what degree do you think folks that you have approached, or they've come to you, or whatever the deal is, to what degree do you think they fully appreciate that?
It's the first
in
thing
in advance of you educating them about that. That's probably a qualifier.
Yeah. So what we try to do is have that be about the first thing that comes out of our mouth, right? Because I think that some owner. I mean, I was in industry for a while, and I sold my company, a trucking company, and I was overt. I said, look, guys, I'm cooked. I've been doing it for 16 years. I'll be around for a transition period, but then that's it. I'm out. And so I think that if both sides are really honest about what they're trying to accomplish, economics aside, I think that gets you the go, no go signal a lot faster. So we try to tease that out, and we try to tell, and you tease it out by saying, look, guys, we're betting on you. We're not going to parachute a C team or even the second level in there. Yes, we'll help supplement, but we're betting on you.
Yeah, I mean, that's pretty clear expectations for sure. One of the things I think it's high compliment to both your team and then your partners at Trident. When we've been in the market and we've talked about the Priority Courier Experts deal, and they understand, to as far as a non-asset deal of that size getting done in that capital market, it's pretty impressive. And so, you guys did something really unique. And so what advice would you give to folks who are trying to source capital that for asset light deals, which in this environment, at least over the last 12 months, have been very challenging? What were some of the keys to your success as far as executing? Because it was no small feat.
No, agreed. Because we don't raise a fund. We raise capital on a deal by deal basis, and have for all of our portcos. What we have to do, and it's a little cumbersome, but we found it to be the right approach for us, and that is going to capital providers, debt and equity, that this particular deal that we're showing to them resonates or is in line with their investment philosophies. And Spencer, I got to tell you, we have to be experts about that business in order to have credibility with our capital providers, for them to say, yeah, Bluejay, we're going to bet on you to be good stewards of our capital on this particular asset. So I think there's just a ton of homework, and we have a fabulous team that helps get that me and some of the other partners kind of up to speed. As fast as they get us up to speed, it's incredible how fast they can get it and put together the presentations. But it's really around understanding the company, being able to articulate what those risks are, what mitigations we have for those risks, what is the growth potential here, how are we going to get there, and who's going to execute that. Because at the end of the day, even though we're going to put, we're going to obviously put our own time into it. We also put our own money into it. And frankly, I'm not going to do that personally unless I understand all those things that our capital providers absolutely demand us to know.
Yeah, well said. I'm curious, is there any particular mode that's of interest to you guys as you look at 2024 and continue building on the good work that you've done in this space?
It's a great question, and it becomes an internal debate here at Bluejay. We'll sit down at quarterly, monthly, on a ski lift somewhere with the partners who say, we need to have a theme. Is our theme drayage? Should we be drayage focused? And where we come out is we're not stepping out of transportation because that's what we understand. And it's a vast network. I mean, you got two other guys here that are very different kinds of transportation, both very, very large and successful players. We've kind of concluded that, look, there's enough commonality in transportation that we can speak that language. It's really about the management team. And then is there a uniqueness to that company that allows the company's management team plus Bluejay Capital ability to come together and do something more so than if the company on its own or Bluejay on its own can do individually. And that's really what it is. I don't mean to avoid the question because we have had these themes that we've chased and our analysts and associates, go out and source and we eventually did invest in those sectors, but it wasn't on the heels of that.
Right. Right. So in summation, invest in good companies. Is that right?
Invest in people because sometimes those companies have gone through some significant challenge, loss of a customer, exposed to the wrong end markets, and so there could be some challenging aspect of it. But because we understand the industry and if we can articulate the risk and how we're going to be able to mitigate that risk or avoid that risk in the future, we're all in. I mean, we could be all in, I should say.
Yeah, I hear your partners pumping the brakes, but right behind you. So
they're not in the home office. I'm free. I can steal whatever I want.
That's right. Well, excellent feedback and insights. Let's get another lightning round here. So let's start with you, Billy. Looking forward to 2024, this upcoming year, there's an endless array of issues and things to consider that may influence. But as you consider, regulatory issues, as you consider industry issues, the freight market, geopolitical issues, which there's no short of, elections, like what are things that are top of mind for your organization as you think about strategy and execution in this upcoming year?
So we don't necessarily focus on those macro trends unless they specifically impact the companies that we're looking at or the companies that we already have an ownership stake in. I think that despite all of that, and I don't mean to be dismissive of those quote unquote headwinds, I do believe that there is a recovery. Most of, all of our portcos, we feel have come off the bottom. The deals that we're seeing seemingly have found the bottom and are moving up, because one of the biggest challenges was, what am I underwriting to? I mean, I know I'm not underwriting to this post-COVID bump, but I'm also not underwriting to, the precipitous fall. And so I think the back half of 23 kind of showed, okay, where these companies are today. So I think from that standpoint, 24 is going to be a little bit easier to kind of come up with valuation. I think sellers have gotten a little bit more real about where their valuation is in the marketplace. doing one of the other gentlemen on here were talking about structure. I mean, no, sellers hate structure. They earnouts and all that. And so I think with more certainty, there is likely to be less structure.
Yep.
And so for all those reasons, I'm not sure I'm necessarily answering your question, but I do believe
You're not.
I'm not. Well, you talked about political, and so I went right into that. I'm going to tell you what I want to tell you.
You're going to land the plane soon, I'm sure. But I understand what you're saying,
Yeah.
and to be clear, I'm not trying to paint a doom and gloom. I actually share the same sentiment. We're actually pretty bullish about what can happen. Just because of some basic normalizations in the space, not any type of favorable tailwinds. But Dan, what say you? How are you thinking about this upcoming year?
Yeah, so we have, as Billy talked about, a number of LOIs and exclusivity processes we're already involved in. I expect to sort of meet last year's outputs by the end of the first quarter. So we have a lot of pent up opportunities. In fact, we probably have more deals than we have capital to spend, room on the balance sheet. So I think the fact that the market has normalized, I think to Billy's point, we have kind of come to what the real go forward looks like. The next 12 months equals the last 12 months a little bit more than usual. I think high interest rates is keeping some buyers off the market still. And so there's this sweet spot of opportunity. I think there's still a lot of people, especially the family-run businesses that are a little bit smaller. They're tired. It's been a grind for the last 3 or 4 years, going through COVID, but also tort reform and insurance premiums going up, and it's a slug. And I think the industry needs consolidation. I think a lot of people who've built up their own companies are tired. You called it cooked, Billy. I think there's a lot of people, and many of them don't have family members that they can give the business to. So, if you can, as Geoff talked about, project a family-run attitude where you're going to carry on their legacy and continue to invest in what they've built and allow them to, maintain that pride, you're going to find opportunities. May not be the best, most dollar. They won't bring every dollar out, but there's a lot of people that still, I think, are motivated to sell. They see as many headwinds in the future, and now's as good a time to get out as any. And we're looking forward to continuing the momentum.
Good word, Dan. Geoff, what about you?
Yeah, I'm gonna put my operator hat on for a minute here, and I guess maybe to provide some context. I mean, we do play in some modes that obviously have kind of been sort of whipsawed a little bit by the COVID pandemic and then the aftermath. And we've had some pressure, right? Like we're playing in the intermodal space. All of our publicly traded competitors have been very open with the market around kind of some of the pressures in the intermodal space. We're a big drayage carrier. I hope to get invited to Billy's drayage theme party the next time that he has it. But we're a big drayage carrier. The international market, while it's not as pressured as maybe some of the domestic transportation modes like truckload and intermodal. Obviously, still pressured a bit. Certainly not what it was in 2022 or the first half of 2023. So we're focused on kind of growing organically across those modes here in 2024. Kind of expanding our wallet share with customers we already have. Kind of putting new customers into the mix where we can, being a very commercially and kind of growth oriented organization. And that's kind of our theme here for 2024, if we were to have a theme. That said, we will still be opportunistic around M&A to the extent that we see opportunities maybe to consolidate, a service or a customer or customer relationships or things like that. But our theme, I would say, for 2024, in addition to drayage, is being a really kind of highly functional, kind of efficient organic growth machine, building that foundation.
I like it. All right, Dan, bring it home for us, sir. Here, let's lean in here and let's talk about it. So, you've talked about deal sourcing, and Tenney Group, we do many seminars about best practices, sharing practices from folks like yourself that we see doing really efficient things as it relates across the whole acquisition process. Deal sourcing is one of those things where you either have it or you don't. But it's also a very learnable skill. And so I'm curious, like, what have been the practice for your group where you're getting a constant stream? Like, where do the deals come from? How are you activating it both internally and externally to give yourself quality at bats to look at quality deals?
I love the baseball reference for sure. So when we started, 2019 it had been a long time since we'd done an acquisition. In 2019, a bank, investment banker brought an opportunity, and we started looking at the process. We had a really good strategic fit. This was Gibson. There's a midstream company that wanted to sell off their original trucking business, and we were successful largely because we weren't in that space, and they wanted someone to partner with. And it was on the backs of an exclusive 10-year service, contract with them. And so I think we got lucky there. Then we started to think, okay, let's do more of this. It's been really successful for both them and us. And we started to hire a few people that were sort of cold calling, go into the NTT CATA meetings, those kinds of things where carriers get together and start spreading the word that we're interested. But one of the things, Geoff talked about it is buying talent. We don't really take a hard look. You talked about earlier in the question, when do you just say no? And when we find companies that they want to sell and retire and move on, we're not really interested. When it comes with talent, maybe it's young talent that wants to stick around, wants to continue to build. They just don't know how or don't have the wherewithal or the balance sheet or the capital capabilities. We like to embrace those folks. And in fact, we've hired a couple of the presidents of those companies into the M&A team because they have such good connections with their peers at industry associations and can put the word out about the experience they had, about how the process went, what to expect, and how good it's been for them, and how many of them would say, they would say, relieved with the fact that they don't have the wait for the phone to ring in the middle of the night because there's been an accident or something like that. The organization can take some of that off, so they can just focus on customer satisfaction and growing the business. And so that's worked really well for us, generating opportunities. But I think, over the last year or so, what we found is the more deals we do, the more people phone and reach out. And so we're finding a lot of people will call just directly. Sometimes they'll hire a banker, and the bankers see how active we've been and that we can be a credible partner or a counterparty in that space. And so we get a lot more looks than we used to. We're finding the need to cold call and participate in industry associations is a little different purpose for those, because we got now so many deals. It's 10-1 that you actually get that you say no to or versus go forward with, and there's a bit of a momentum that's building off of that. So that's been I think really successful, and looking forward to seeing where that sort of flywheel effect takes us forward, because you've got that credibility and that reputation for being an acquirer in the future.
So let me unpack that a little bit. You mentioned 10-1. I think this is really helpful for sellers. What could future sellers? I talk about this all the time. It's you can't replicate when someone knocks on your door with a strategic pain point that you can solve for them, and so you can do all these things to enhance value for a future sale. But if you are a solve for a very expensive problem for somebody else, it's hard to replicate that later down the road. And so we always emphasize readiness. And so my question to you is, what advice would you give to business owners, no matter where they are in their company's life cycle, to stand ready? So if somebody like you provides a very compelling proposal to acquire their business, they can actually be considered and entertain it.
Yeah, I think, Geoff, you hit on it earlier in the conversation about buying good companies, good management teams. Billy, you talked about that. We actually look for companies that help our operating ratio. When you get to be $1 billion company, it gets harder and harder to chip away at operating ratio and profit margins. And so we spend a lot of time looking for companies that have better operating ratios. And a lot of that, it tends to be smaller, more regional based carriers who don't have a lot of overhead, and they've got a lot of backhauls and those kinds of things. They're really profitable. And we look to buy those companies we can buy trucks and trailers, but I can't learn the themes in those marketplaces, the communities that people live in, and the customers and those kinds of things, those relationships that take decades of building trust with each other. Those are the companies we look for. What we can bring is a back office. We can bring insurance structures, risk management, corporate structure, legal teams, all those kinds of things, access to capital, those kinds of things. So we look for companies that are really, really good operators, have good customer satisfaction, good tenure with customers, good retention rates with drivers. If you've got those things, we can help with all the other stuff. And that's usually the stuff that people stay up at night going, what if there's an accident? How am I going to make payroll? The accounting stuff, the audit stuff. Those are the things that we have a lot more experience and sophistication, but I don't know that market or those customers or that equipment type like they do. And so it really becomes a good partnership where let us work together and continue to invest in those markets, in their people, their brand. We haven't once taken the acquired name off the side of the trucks. We leave those on all the time, and so that's part of what we try to get people excited about.
I'm curious, how does your group, when you're looking at the operating ratios, what's a pocket range where there is consensus within your leadership team that this is a different business that we need to consider acquiring? What's the pocket that you think that they need to be in to get that type of attention?
Well, some of it's really market specific. We're a bulk transporter, so the numbers don't even make sense for dry van reefers or drayage carriers. But if we're sort of a mid-90s operating ratio, then we're looking for anyone that's less than that. Anything sub 90 is a great business that can be accretive to our operations overall. And so we look for those. But then if you get into brokerage businesses or equipment leasing businesses, transloads, warehousing, they're all complementary business. Geoff, you talked about adding services that I can insource instead of outsourcing with our customers. We look to add and diversify our services. We look to bring in new markets that, or geographies or commodities that we don't participate in. And those can all be really complementary where I don't need the entire cost structure that comes over. And so synergies plays a part in that too. But generally speaking, that low 90s into the 80s is a really attractive business that it's hard to replicate. It's certainly to start up on your own from an organic perspective.
Well said. Well said. One more question, and then we'll have a final lightning round with our esteemed panel. So Dan, I'm curious. There's so many, as a couple of you mentioned about this. There's an aging demographic of business owners without successors, and a lot of those folks know that some type of transfer of ownership is imminent, but for 20, 40 years in some cases, their whole identity is tied up into this business, and so there's a fear of change. What encouragement would you offer to folks that desire to continue a career in trucking and logistics without all of the weight of ownership on their back? And you kind of alluded to some of this, but can you paint a picture for us as far as what are some of the, I guess I would frame it this way, what are some of the misunderstandings that a lot of founders have about what it's going to look like post-transaction, and what encouragement can you offer them?
Yeah, and I think that question is why we started to hire some of the former operating or senior leadership team off the acquired companies into our M&A space, because they can answer those questions. I've been in meetings with the owners, and they closed the door, kicked me out, and they just want to talk to the guy who just sold last month or last year, and ask him what it's really like, right? Because we all have a tendency to position and sell what we can offer, but it can be a bit of a corporate storyline that doesn't tell the whole story. And so that can be a very effective marketing tool for us, is to be honest. But at the end of the day, I think wearing the weight of ownership, you talked about it, they still love the business. They know the industry. They know the customers. They know the drivers, the people, the turns, the markets, and they want to keep doing it. It's all they've ever known. And so when they get an opportunity where I don't have to live with the potential for a 3 a.m. phone call, with the risk, with the insurance, with the all those kinds of things, the regulatory changes, the technology changes that are coming with autonomous or electric vehicles and emissions control and all that stuff. When they can continue to build their business and develop and run and grow and keep their customers happy, but they can take some of that weight off, they're usually quite intrigued by the opportunity. I think the opposite is also true, that a lot of these players are also very much afraid of what can happen because they've heard horror stories of somebody coming in and starving them of capital and flipping them to the next buyer and consolidating them with other businesses. That there is a reputation out there for some that could happen, and so they're a little bit worried. And I think that gets more airtime than the story that I just told. And so we do a lot to educate people on our approach. Right, Trimac is still family owned, and the intent of the family is to continue to give this to their grandchildren and so on and so forth. We have no exit point. We have no flip, no IPO that's coming, and that usually calms people down so that they go, okay, so I'm a family-run business. They're a family. Our interests are aligned. I can start to trust and build that relationship. And these processes take 6 months or a year, or can, and so it takes a while for everybody to get comfortable, but usually they do. And then often they're interested in jumping into the M&A team or the corporate development space and going, hey, I want to tell my story and share that experience, and that's what creates that positive flywheel for us. I think that's a good way to say it.
I love that. All right, final question, guys, and thank you so much for all that you have contributed to this. So my final question is this. Over the last, call it 9 months, Tenney Group has experienced a record inbound interest from new acquirers, strategic acquirers within this space that recognize to combat all that's going on, they're going to have to innovate their growth strategy to offset some of these rising expenses and other challenges. So what advice would you give? And we'll start with Geoff here. What advice would you give for the folks that are going out and doing their first acquisition, integrating it for the first time in 2024? What advice would you give to them?
I would say my first piece of advice would be spend a lot of time getting to know the folks who are going to be running the business for you or that you're buying the business from. And invest the effort in understanding what motivates them, what risks do they see, what opportunities do they see. Communicate clearly with them around what your expectations are and how you see them fitting into the broader picture of whatever your vision for your company is. I think if you do that, you continue to kind of nurture those relationships post transaction and continue to kind of follow through on whatever commitments you made to them. You've done kind of the hard work, kind of all the due diligence and structuring and all that stuff. I think that is probably first and foremost. If you don't get that part right, the odds of having a successful transaction and it accomplishing what you expect it to do or what you expect it to bring to the table for your broader company, the probability of that happening declines rapidly.
Dan, your thoughts?
Well, I think the one thing is remember why you're doing it. Low margin business is difficult to have spare trucks and trailers and drivers hanging around so that you can jump on new opportunities. And so acquisitions is a really good way where you've got a business that's running that you can acquire and integrate. And so you're looking for areas where I'm not in that spot. I don't have that spare equipment, that expertise, that customer knowledge. If that's why you're getting into that acquisition, you're bringing something that's complementary to your company, whether it's to a region or a service line or a capability to add to customers, remember that that's why you're doing it. And so when you start thinking about integrations, you think about they're the experts in this market or this space or with these customers. I am not. Don't try and tell them how to do it. We have certainly learned the hard way where you try and put them on our systems and put them on this and put them, and it doesn't work. It unwinds them and actually makes them worse off. And so we have been very, very diligent the last dozen or so acquisitions where our focus is to allow them to continue to run, take a long time to think about what you want it to look like in the long run, and have them very much a part of the decision making on what the future is going to look like because they know that market, they know what it took to build it up and be successful. And so, how do you preserve that together? And it really jumps back to remember why you're doing it in the first place.
Start with why. All right, Billy, put a bow on it for us, sir.
All right. What advice would I give? I would say that, particularly if we're talking about founder-owned businesses, and if we're in the lower middle market, that's probably what we're talking about here. Show respect for these sellers. I mean, these folks have built, in many cases, something out of nothing, which very few people can do that to a successful end. And if you're looking at them to purchase, they've probably done that to a successful end. So I would say that that would be number one. I would say number two is, it's almost, as a buyer, I think we forget as buyers that, okay, we've got this capital, you want to sell your business, so we're just going to come and put a bag of cash on your desk and everything's going to be right. I'm oversimplifying it, but the point is that how are you going to be a good partner for this company? How are you going to, whether they stay or not? Because make no mistake, these folks, by and large, want to know, are you going to be a good steward to their baby? I mean, their entire career probably, or a good portion of it, has been dedicated to growing that business. So I think that there's a lot of, I think us as sellers, and me included, we forget that. And it's good to remind yourself that you need to bring something to the table. You need to tell these folks, we're having a tornado in Jacksonville.
Wow. We'll wrap it up quick.
Yeah, sorry about that. I know, no beeps. Anyway, so and I would say, let's understanding what those owners want to do post close, and sometimes they don't. It's not fully baked in their mind, but really understanding what they want. Do they want to exit? Do they want to stick around? Do they just want to stick around for a transition period? Do they want to position one of their folks into the CEO role? So understanding that can help you structure what your deal is. So it's a lot more focused on them and not you, particularly on the front end of it.
Listen, what a way to end it. Gentlemen, I am so grateful for you being so generous with your experience, with your insights to our industry, the best industry in America, if you ask me. That's going to do it for us in this special edition of The Hot Seat. We will see you next time.